Hey there guys, how's it going? Chris Chillingworth here. Welcome to episode number 52 of the FTSE Show. If you are new to the show, if you've not watched any of this before, this is a show dedicated to the financial analysis, I suppose, of FTSE stocks, UK FTSE stocks. We've gone through the FTSE 100, the 250, the small cap, the fledgling and the AIM indexes, and we've looked at all of these companies, and I've handpicked a number that I want to invest in. But this show is all about looking at everything. It's looking at the good and the bad, and we're going to look at some companies that are atrocious investments, and we're going to look at why they are. We're going to look at great investments, companies that I really like, and we're going to look at companies in the middle, companies that are, not terrible investments, but probably not the best opportunities that are out there. And that's what this show is essentially all about. I've been away for probably 2 years now. I think it was 2 years ago that I did the first season of the FTSE Show. I went away and I really wasn't sure whether or not I was going to be doing a season 2 or ever coming back to the show again. But recently I hit 40 years old and I felt genuine regret for not doing the show. And so here I am, back in it. I've lost my backdrop, which I'm gutted about. I used to have, if you watch season 1, you'll know I used to sit in front of my library of about 400 books. I no longer have that location anymore. My books are in storage. I'm gutted about that. I need to sort this setting out. The light is not good enough. It's too gloomy, so we need to fix that. I've got some lights coming this week, so that hopefully episode number 53, maybe 54 will look better. So we'll slowly increase the production of the show. But the most important thing about the show is the content, what are we going through. And so today, we're going to take a look at a company called ShoeZone. So ShoeZone are a company we've not looked at before on the show. This is a kind of a discount, cheap shoe store you'll see in a lot of high streets. They've got, I think it's about 500 stores across the UK and Ireland. I might be wrong. We'll look at that in a moment when we come in. But they bought Stead & Simpson, a big shoe store chain, in 2009. Bought out all the stores, acquired them, turned them into ShoeZone stores. They sell about 20 million pairs of shoes a year, and they floated on the London Stock Exchange in May 2014 at a price of £1.67 per share. They're now trading, as of today, at time of recording, at £1.47 a share, and that's 8 years later. So that's your first clue as to what's going on with ShoeZone. The share price is pretty much sitting exactly where it was 8 years ago. But we're going to dive in. We're going to look at why that might be the case. We're going to look at what do we think of this company as an investment opportunity. And again, we're going to talk about why they're good investment, why they're bad investment, that sort of thing. So hope you enjoy the show, and we'll dive in and take a look.
Okay, let's take a look at ShoeZone then. So ShoeZone, pretty much well known in the high street. You see a lot of their stores in the high street. They've actually got over 500 stores across the UK and Ireland, so you're bound to have come across them before probably. They're a footwear retailer in the UK and Ireland, and they sell shoes at discount prices. Essentially, they're quite cheap and cheerful, and they obviously make their money through the volume of sales rather than high level, high priced items. They have 3,400 employees, and the headquarters are located in Leicester. In terms of noteworthy history, they bought Stead & Simpson in 2009. They were, I don't know if you remember their stores, they were kind of green with Stead & Simpson right across the top, and also a shoe seller. They came in and bought them out in 2009 and acquired all the stores essentially, so that was a big part of their expansion. And they floated on the London Stock Exchange in May 2014. They floated at a price of £1.67 and trading as of today at £1.47. So we're looking now at, what's that? That's going to be 8 years of trading on the LSE, and they are essentially at the same price as they were back then. I've gone through about 1,000 FTSE companies. Most of those companies I've looked at over 10 years of financial data per company. So we're talking about 10,000 years of financials essentially that I've gone through, and I'm still going through now. And you when you do that, you tend to see patterns. I mean, it's taken over my life. The last 3 years of my life has been pretty much every week studying companies, studying financials. And it's not for everybody. Most people don't want to do it. Most investors would never put that kind of time in, but it's just something I love doing, and it's kind of my my thing, I suppose. And when you do that, you tend to see, or I tend to see, a lot of patterns. One of those patterns is that when companies are not making any profit or quite enough profit to reinvest into growth, they tend to stay stagnant. Revenues tend to they kind of grow with inflation, but they're not really growing. They kind of revenues will generally go up over time because of inflation, but it's not a sign of company growth. And you tend to see that everything is stagnant in the numbers, or they're going in the wrong direction, and they're not really making much progress. And it's companies like that are they've reached their pinnacle. They've got nowhere to really go. It would take a big shake-up or a new CEO come in with new ideas to really shake up the business and to really expand it, and that's quite rare. And so what you tend to find is that companies will grow and grow and grow until they reach this kind of plateau, I suppose, where they're making a little bit of profit, but are not enough to do anything special in terms of growth of the business. And what you tend to see in correlation with that is a share price that kind of just stays flat. It doesn't go anywhere. And for me, those are the kind of companies that I don't invest in. I'm not really interested in companies that don't really go anywhere. There are dividend investors will find companies like that maybe quite useful, because they tend to put whatever profits they've got into paying dividends instead. So if you're a dividend investor, you're looking for a different type of company than I am. I'm looking for growth stocks. I'm looking for stocks that are going to grow in share price, not just pay out a decent dividend. So let's take a look at the vertical analysis then. So we're looking at year by year what's been going on with Shoe Zone. We can go back to 2013. That's the earliest data I've been able to obtain. Obviously, they floated in 2014 onwards. So we look at revenue. The first thing that stands out for me is revenue has been falling, and it's been consistently falling, and that's a red flag for me straight away. Back in 2013, they were making 194 million a year in revenue, in money coming in sales, in other words. 2014 it's gone down to 172, then down to 166, then down to 159, then down to 157, and it's just been falling and falling. And then 2018, 2019 they saw a very slight increase up to 160 and 162, but then 2020 down to 122, and then 2021 is their worst year since they floated in 119 million. So they've gone from 193 million to 119 million over the course of 9 years. 9 years of financial data. So that's a bad sign. We don't want to be investing in companies that are shrinking and falling and making less and less sales every year. We want to be investing in companies that are growing and expanding and doing better and better. And so this is a bad sign straight away. Doesn't mean it's the end of the world, but it's a bad start, right? Cost of sales, that's the cost of essentially getting the shoes in to sell, because that's pretty much all they sell is pretty much shoes. So cost of sales has been falling in relation to the drop in revenue. So what that might suggest is that as sales are going down, the company are buying in less shoes, or they've got a system where they only buy what they need as they go, and that's good. That means they can maintain their profit levels despite the fact revenues are falling, because they're spending less as the revenues are falling. It's not good. It's not sustainable. It's not good long term. But at least they're managing the situation, which is good. It means gross profit has pretty much stayed around 27 to 32 million a year. They had their bad year in 2020. That was due to lockdown. And many high street stores suffered in 2020 because of that, and they suffered slightly in 2019 as well. And even 2021's been disrupted somewhat for retail due to a number of different lockdowns at different times that came into play in the UK. But gross profit has pretty much sat at about 28 to 32 million a year, and that's been consistent. So it's been going on now for 9 years, which is good. At least we've got some consistency there. And we've got our gross profit percentage. So what's the percentage of the revenue that they're keeping as gross profit? Not complete profit, not net profit. This is just gross. This is before expenses, before taxes and everything. So kind of raw profit, if you will. And the percentage is too low for me as an investor, and what I'm looking for in a company. That gross profit is too small. I set my bar very high. The only companies I'm interested in even analysing in detail and really getting to know well, and really starting to consider investing in are companies with very high percentage of gross profit, because I want them to be able to have high profits, to be able to reinvest back into the business, to be able to grow, to do exciting things with. And when you're only making sort of, 15% a year roughly on average here, gross profit, that's not going to leave much for expansion or doing anything with. Expenses are quite high. They're not end of the world high, but consistently looking at between 63% and 70% of the gross profit being eaten up by expenses. They obviously had a bad year in 2020 due to lockdown, and actually the expenses came in at 256%, which was a bit of a killer for them, and that's the reason why they lost quite a bit of money that year. But we can kind of ignore that, because obviously it wasn't a normal year for the company, and there were matters outside of their control that influenced that. And then at the bottom line here, we've got the operating profit. So after expenses, essentially, what profit was left over. And again, 2020, they made a 12.7 million loss, but tend to make about 10 million a year. That's the operating profit that they tend to be making. It's about 10 million in profit a year. And that's been consistent since about 2014 onwards. So since they floated, you can expect them to make around 10 million a year, which is pretty good. At least it's consistent, right? And that does count for something. Looking at the earnings analysis then, so going a bit deeper into that earnings. So we've got our operating profit across the top line there, as you can see. And then we've got finance expenses. So what's the interest that they're paying on things like debt, essentially? And that has increased because in 2020, the company took out some debt, and we'll look at that again in a moment. And they did that to obviously try and protect the business during lockdowns. We've got the sale of assets and other income. Both of those are zero. They've not reported any sales of any assets. They've not reported any strange other income that we can't really explain where it's come from. So that's good. That means that everything we're looking at is pretty much a reflection of their day-to-day business, of them actually selling the shoes. They're not selling off big chunks of their business to raise other income coming in. This is just purely what they're doing on a day-to-day basis. That's good. It helps us. It makes things a bit easier for us as an investor to identify what's actually going on here at the business. Then we've got taxes. Taxes are nothing you can really say about taxes. They pay what they have to pay, and they got a little rebate in 2020 because of the poor performance financially. But otherwise, yeah, they pay what they have to pay. And then reported profits, that's going to be the same as true profits this time round, because as I say, we've got no sale of assets, we've got no other income that's going to muddy the waters, so it is what it is. And as you can see, true profits, we're looking at about 8 million a year. So operating profits 10 million, but by the time they've paid off their financial expenses, i.e. their interest on debt, and they've paid their taxes and things like that, then we're looking at this as a company that's making about 8 million a year roughly. They lost about 12 million in 2020, but generally speaking, this is a company that makes about 8 million profit a year. That for me, unfortunately, is not enough. And I work that out by looking at the profit percentage of the revenue. So of the revenue, how much of that revenue is being kept as profit at the end of the day, at the bottom line, after taxes, after interest on debt, after expenses, after all of that kind of stuff. Once everything has been removed, they've paid off all the staff, they've paid the directors' bonuses, whatever it is that needs to be paid, what is left? And it's about 5%. Historically, it's about 5%. That's too low for me. It doesn't mean that they're a terrible business. It doesn't make them a terrible investment. 5% profit is better than a company that's breaking even or making a loss, right? So they are definitely, on the right side of the line. For me, though, because I set my bar so high, I know as an investor there are far better opportunities out there. So for me, I wouldn't be invested in Shoe Zone purely because I know there are better opportunities out there. There are stocks out there that have that give me a much better opportunity to see their share price rise than Shoe Zone, because Shoe Zone, if they're only making 5%, that's not going to give them much to play with to be able to grow that business. And if they can't grow that business, the share price is unlikely to grow with it. Okay, so I hope that makes sense. We could take a quick look at the debt analysis. They are a company that do use debt. We'd look at the true profits then across the top of the line. So we've just taken the bottom line from the previous slide, the profits left over at the end of the year, and we put them across in the top here just to give a frame of reference. Then we look at short-term borrowings as the next line. So this is money that they've borrowed that they have to pay back within a year. So that's what short-term essentially means. And you can see here they've dabbled from time to time. They've borrowed a bit here and there, only a couple of million each time. They've currently got 4.4 million in short-term borrowings outstanding. And then underneath that is long-term borrowings. So these are long-term lending deals with providers, and they took out a 5 million loan essentially in 2020 just to probably cover the lockdown. This is something that I've seen a massive pattern of happening across the FTSE. Many companies took out a loan in 2020. Even companies in great financial shape took out a bit of borrowed a bit of money from their lenders just to kind of hedge and just to prepare themselves for what might be around the corner, because there was, during lockdown, a tremendous amount of uncertainty. No one really knew what was going to happen, and so these companies all did the right thing and they all borrowed a bit of money. The earnings to debt ratio here is fine. Obviously 2020 I'm kind of ignoring because they made a loss that year. Lockdown had a massive effect. They borrowed money, so they were borrowing more money than they've ever borrowed before at a time when they were making the worst amount of financial returns possible, and it's going to mess up the earnings to debt ratio. But generally speaking, this is a company, and 2021 they've got themselves back in order. They got 4.4 million in short-term borrowings outstanding, and they're making profits of about 7 million a year. So that means they can afford they're borrowing at a level that makes sense to the size of their business. They're borrowing within their earnings power, so we're fine with that. That's absolutely fine. There are no concerns here therefore regarding debt. We take a look at equity analysis. So what's the company worth? So we look at the assets. The assets have been flat from 2013 to 2019. They really haven't gone anywhere. In 2020 and 2021, things started to jump up a bit. We've got the liabilities. The liabilities did exactly the same thing. They've been flat from 2013 to 2019, and then 2020 they jumped up a bit. And then really the true picture is the net worth. So what's the assets minus the liabilities gives us our net worth. So from 2013 to sort of 2019, you're looking at about 30 million net worth, and not really budging. Obviously it ebbed and flowed. It's gone up, it's gone down, but it's still, by 2019 we're still sitting on a company that's worth 30 million, same as they were worth in 2013. So that's not good. I like to see a company growing, and this isn't a company that's really particularly going anywhere. 2020, that net worth has dropped down to 12 million. It's recovered somewhat to 23 million by 2021. That's the latest annual report that we've had released so far, of course. And so what it's showing me is just it's flat. The net worth is flat. This is a company that's not really growing in value at all, and that's going to impact the share price. So as you can see, May 2014, these guys floated at £1.67, and the price has been relatively flat. We've seen some droppage during lockdown, where the majority of stocks around the FTSE suffered during that time period. So that's to be expected. To be fair, the price had been falling prior to lockdown kicking in, but obviously when it did, it really knocked it flat, and we actually saw the price fall to a low of about 34 pence at one point, and it has recovered since the start of the year. This is a stock that's done pretty well in 2021 and 2022 so far. We've actually seen some quite significant growth here in the business share price, but it's still at £1.47, and it is still flat considering where it was back in 2014. I mean, if you'd invested in this company in 2015, now fast forward 7 years and the share price is lower than what you bought it for, it's a bad investment, right? It's not a great growth stock. And from what I can tell, from what I can see in the numbers for ShoeZone, I wouldn't expect to see much growth unless something drastically happens. A new CEO comes in with great new ideas to expand the business, perhaps, or something like that, or they manage to rustle up enough money to buy a new exciting acquisition that they can bolt on to the company. Something like that would need to happen for me to reconsider this stock in any way, because all I can see right now is a stagnant business with revenue falling year after year, and they're not really going anywhere. And I would expect that in 5 years' time, if they're still around, their share price probably won't be much higher than £1.50 to £2 a share. So because there's no growth there. It's a company that's kind of reached its pinnacle, it's reached its plateau. It can't really expand from where it is. It's only making 5% profit a year on a good year. and it's got nothing to really reinvest and nowhere to really go. So yeah, that's what we're looking at in terms of ShoeZone.
Okay, so a profitable business to start off with. So we can tick that off. They are profitable. They're making about 5% a year, which is good. You know, there's a lot of companies. You'll be surprised. Having looked at 1,000 FTSE companies now over the last few years, and I've been dedicating the whole 2 years that I've been away, I've not stopped analysing companies. Just because I haven't been doing the FTSE show doesn't mean I've been stopping what I've been doing. In fact, I've been busier than ever in the last 2 years analysing companies. It's what I do full time. And so I found a lot of companies making losses. I mean, they're not growing at all, they're shrinking. So ShoeZone have that positive about them. They are actually making a profit. That's a good sign. But not a great investment opportunity right now, as far as I'm concerned. I believe that there are more exciting opportunities elsewhere than with ShoeZone. And I really wouldn't expect much to happen to the share price over the next 5 years. I really wouldn't expect much movement for the reasons we've just looked at, going through the numbers. The fall in revenue is a concern for me. That is a big concern. I don't like to see companies making less and less in sales. That's a bad sign. Obviously, no dividends being paid out as well, which is, for dividend investors, that's bad news. The share price right now is not overvalued. I think the share price right now is cheap relative to the value of the business. However, what's the benefit of buying a business on the cheap that's not providing you any growth, any strong profit return? I think what we'll tend to find is that, yes, you can buy the shares cheap right now at £1.47 a share, but I really wouldn't expect them to go above £2 over the next 5 years. I might be wrong, but in my experience of analysing these companies that are flat, that really aren't going anywhere, that haven't got any profit to reinvest into that business, aren't really going to go anywhere in terms of share price, unless something big and unpredictable comes along. But in terms of predictability, this doesn't look like a company that are likely to do much exciting things with their share price in the next 5 years. So we want cheap stocks. Obviously, we need a best of both worlds. We're looking for cheap stocks, but we want growth there as well. This is a cheap stock, but there's no growth. So that's what we're looking at. The only thing left to do now to wrap up this episode is to look at the clean score. This is a score that I apply to every stock that I analyse to quickly identify their value as an investment. So companies that score probably 60 or higher are companies that I will spend a lot more time looking into, because the financials are all there. So clearly they're doing something right, and the financials give me it's kind of like a triage. I'll very quickly be able to identify, is this a company I want to spend some more time on? Because I can spend 10 hours on a company easily, probably longer. Analysing that company, looking through 10 years of annual reports, looking at all of the 10 years past financials, looking at reading every CEO report, every chairman's statement, looking at every financial director's reports, looking at what the growth strategy is of the company, and trying to identify if I feel that makes sense. All of these things takes hours and hours of work, and so I can't do that on 1,000 companies. I just can't do it. So I triaged the stocks, and I try and identify what are the right ones to be spending that kind of time in, and which ones do I just need to leave alone because the financials just don't warrant the extra work. Having looked at the financials of ShoeZone, having put them through the algorithm, they have scored 5 points. So when I'm looking for 60 plus for a company that I would spend way more time looking into, ShoeZone unfortunately do not come close. You're going to find, if you've watched season 1, you'll know the vast majority of companies we're going to look at are going to end up with minus clean scores. That is a reflection of just how bad the whole market is right now, in terms of there are a lot of UK companies hemorrhaging money and not making any money at all. ShoeZone at 5 is a respectable score, but it's not going to be a company that I'm going to want to look to invest in. So as we go through the episode, you'll see this scoreboard grow and evolve and change, and we'll start to build a leaderboard of all the stocks, just like we did in season 1, only this time it's more digital. And 5 points. Not a company I'd invest in. Look for better opportunities. Thanks for watching, guys. See you soon.